we came post-pandemic and what are the key macro indicators and how the market for steel and iron is going to be on macro side. We are not talking about the price forecast in today's webinar. Definitely in next subsequent webinar, we will be looking for quarter-on-quarter movement of iron and steel, how the things will be moving. So let's start with today's session with the overall snapshot. So as we know, India is on the track of $5 trillion economy by 2025. Already we have seen we have a consistent showing a growth with the averaging around 7% over the past decade. Indian government has implemented several economy reforms to boost the economy. We have seen steps such as GST, insolvency, bankruptcy code, that is IBC. India is the fastest growing major economy with a projected growth of almost 7% in 2020, 21, 22. The country has almost large growing consumer market and a population with over 1.3 billion people. India has strong technology sector, and with the large number of startup growing number of unicorn, the country has good number of workforce with a median age of 28. All this attractive will definitely attract the foreign investment, particularly in the area of e-commerce, renewable energy, and infrastructure. Similarly, the numbers, macro numbers, we can correlate with this all what we are discussing right now. It's the India GDP number. We have seen Indian GDP at the time of COVID that has been impacted globally. We went down towards minus 23.8, but since then recovery was been very fabulous. Right now, our GDP growth has been going very well, and the numbers like Indian peak power demand, demand supply touches all-time high. This is just a few weeks. First week of June only we have seen things have been. Power consumption is a key indicator where we can come to know how the industrial demand has been prevailing. Even on GST collection also we have hit all-time high. We have started with the numbers like let's say 90,000 or 1 lakh, but now it virtually crossed 1.6. So this is a very good showing an indicator that India economy is going very well. Even on the agriculture side, India food grain production estimated at 330 million tons for 22-23 as per third advance estimate. So in all the sectors have been growing very well as of now. Even from the government point of view, government has started with many new development. No doubt, we know whenever there is a pandemic-like situation or recession-like situation, government makes sure to come up with many development plans so that it should support the economy. So we have already seen government has started their initiative from infrastructure development, whereby there are many projects are going on in India right now, like Bharatmala Pariyojana, which is a development of 83,677 kilometers of road across India. Sagarmala project, that is modernization of ports and port link infrastructure. Smart city mission, development of 100 smart city across India. Atal mission for and urban transformation. Pradhan Mantri Gram Sadak Yojana, which is a very crucial because connecting the rural India to the urban, which is the main objective of this Pradhan Mantri Gram Sadak Yojana. Similarly, we have seen in manufacturing activity also has been promoted by government, like Make in India initiative has already been started, and we have seen it is going very well, increasing the share of manufacturing in GDP. Even National Manufacturing Policy, Industrial Corridor Development Program, modified special incentive packages scheme has been launched for electronic manufacturing companies to set up an operation in India. Production link incentive is a very, we can say, positive, creating a very positive impact on all manufacturing companies to boost the production and to have an attractive investment. Similarly, as we know, today is a decade of, we can say, digital economy, and we have seen during the COVID, digital acceptance has been tremendously went up. So we have started, government has initiated with the Digital India initiative, transforming the India into a digital empowered society and knowledge economy. Even National e-governance plan that has been already been started Startup India initiative, modified electronic manufacturing cluster scheme, or last would be, so not last, but in that line only, software technology park in India. So in every aspect, government is going very well, from manufacturing to infrastructure, then digital. Now in renewable also, we have heard right now, because of volatility in crude oil prices is impacting every corner of a country, let it be India, China, US, Europe. Everyone has been suffering because of this Russia-Ukraine concern since last 1 year. So already government has started with a national solar mission, promoting the solar power in India to achieve 100 GW for solar capacity by 2022. Already things have been improving in this. Similarly, national wind solar hybrid policy to promote a wind solar hybrid project in India. Ujjwal Discom Assurance Yojana, improvement of financial health for state power distribution companies, which will definitely improve the last mile connectivity. At as we have seen in last couple of years, things have been very much improved in rural India as of now. Kishan Urja Suraksha Evam Uthan Maha Abhiyan, which is again promoting a solar pump and grid connected renewable power plant to farmers. All these activities are been going on. Even national biofuel policy has been adopted in order to reduce the dependency on fossil fuel. Even from the agriculture point of view, we have seen Pradhan Mantri Fasal Bima Yojana, Pradhan Mantri Krishi Sinchai Yojana. Everything has been now printing up. With this all sector, we can say focusing, we have seen tremendous changes in last quarter, or we can say if we compare the Indian economy from December 22 to March 23, we have seen GDP has gained from 4.5 to 6.1. Private consumption has improved from 2.2 to 2.8. Government consumption that was in negative, or showing a negative, as came up towards 2.3. Export has improved significantly from 11.1 to, we can say, 11.9, despite global economy has been slightly having concern with the recession and all. No doubt our imports has continuously in control from 10.7 to 4.9. Manufacturing activity has improved significantly from -1.4 to 4.5, and construction activity has crossed the double digit of 10.4. All these thing has been showing that how the recovery in India has been tremendously going on. With the transforming the Indian infrastructure, we have already seen we have achieved road, railway, port, because all these sectors are highly correlated with the steel prices and steel consumption. We'll see later on this presentation. Here we can compare from last 10 year to upcoming towards 2030. There could be a gain of almost 43% in road connectivity, railway connectivity, ports, airport, and power. And as we know, all this sector infrastructure needs steel. So already we have seen infrastructure spending in India is continuously rising post COVID, and government has been trying to increase the capex. So here the share of steel used in infrastructure projects are around 10 to 15%. Share of steel used in automobile sector is up to 65%. Share of steel used in construction sector is almost 35%. So everything is been in line, and that is why the consumption is been improving, and resulting that the growth of steel industry in India is been rapidly in last 20 years. In the year 2000, we were almost our production capacity was 23 million metric ton per annum, but now it has been increased multifold to the level of 150 million metric ton. Export has improved from 0.8 to 13.5. Import is also been increased significantly, and even on the ranking side, we were around 14th in global market. Now consistently since from 2020 till now, we are ranking second as per the Ministry of Steel data shows on World Steel Association. So everything has been connected, and as Indian growth stories are continuously going forward, and consumption of steels are improving, we expect the prices or consumption for next half of the year is going to be very much strong, as already we have seen the production capacity has been improving, exports are improving. No doubt import has slightly been sluggish as of now, but I think as the price is competitive, we can see a further growth in the demand from Indian side, as government of India has started with a many new initiative for steel industry like PLI scheme, or we can say Steel Research and Technology Mission on India. So India Steel Policy 2017 has been created to create a self-sufficient Indian steel industry that technologically advanced and globally competitiveness would be there for Indian market. Domestically manufactured iron steel product policy has also been encouraged, made to encourage the domestic manufacturing activity. So most of the time, government was been slightly, we can say, was looking forward for steel industry, and we have already seen in October 2021, government announced the guidelines for the approved specialty steel production link incentive, that is PLI scheme for steel industry, and which has transformed the scenario in last 4 5 years. So overall, we expect after this incentive scheme, things have been improving in domestic side. In fact, October 21, we have seen India and Russia sign the MOU to carry out the research and development in the steel sector and produce the coking coal used in steel making. Under the budget of 23-24, government has allocated almost 70.15 crore, that is around $8.6 million for this budget to the steel ministry. Major of the fund we have already seen it is been utilized in R&D only. And secondly, the government has raised the import duty twice this year. In June 2021, JSW Steel or CSRI, just NCL, everyone has joined the commercial and hydrogen in the steel and cement sector. So everything has been in line and things have been improved. India has been decreased with the is a good sign. Import has been good sign, but have to see the global market. So up till now, we have seen Indian economy are strongly recovered from post-COVID, showing a broader base growth across the sector. Let it be digital, let it be infrastructure. Everything has been in line as of now. Strong economic growth in first quarter of 2022-23 has been helped India to overcome the UK and become a fifth largest economy. Robust GDP growth expectation is been expecting in financial year 24, with the range forecasted is 6 to 6.8 range. MSME sector experience over 30.6 credit percentage of credit growth in June to November 2022. Indian rupee has strengthened. As of now, we can see this stability has been there in Indian rupee. Indian forex reserves stood at near to $600 billion, which is also a good sign. Government capital expenditure and private investment boosted this sector. All these key indicators have been improved, like GDP number on inflation, and came down rapidly, and Indian consumer price index is stable as of now. FDI and gold reserves have been improved significantly, especially if we see FDI, there was an initial fallback, but now things have been improving for FDI, but gold reserves have been stagnant. Export and import, we can see initially there was a recession fear, that is why some sign of weakness was there from the Western world, but things have been improving. Initially, the numbers from Eastern world of like India, China, or we can say Eastern countries have been improving faster as compared to Western world. Composite PMI has been consistently holding very well near to 61 level since last couple of months. Manufacturing PMI is improving month on month. From January 23, we have seen figures have been consistently holding 58 level mark. Even service PMI has been stagnant above 60 level mark, but consumer confidence data shows improvement has been significant from India side. So what we see, looking to the national steel policy that has been adopted in 2017, is been aiming to production capacity, to increase the production capacity in steel, and to target 300 million tons by 2030 is in line only. Similarly, steel scrap recycle policy in 2019 is been still improving the things, and we are expecting the steel scrap in India to 70% by 2030. Promotion of steel usage in infrastructure development has significantly improved, with the government has targeted constructing 60,000 kilometer highway by 2022, and significant part has been already done. We have seen in earlier slide, things have been infrastructure side, India has been improving significantly. Development and steel cluster attractive foreign investment in steel sector has been seen in the last few quarters also. But there are certain we can say concerns, and some prospects are there for next 6 months, like let's say raw material availability and cost, because significant rise in other commodities has been seen in last 1.5 year period. Now maybe in last 3 months prices have been stable and prices have been slightly coming down, which is a good sign, no doubt. But again, the geopolitical concern is still prevailing from the Russia-Ukraine side, which has been impacting the raw material prices globally. High production cost, as we know, things have been as things have been improving post-COVID. Cost for many overhead expenses has increased simultaneously. Competition from import, but I think in last 4 5 years, India has significantly cut down their imports, which is a good sign. So there is a little bit concern, no doubt, but I think things have been improving from the import side. We are net exporter right now. Environmental concern, this is a regular thing, like manpower, because capacity improvement is there, but skilled manpower is a concern. But volatility in global steel prices will be definitely keeping Indian market on toes. Whereas the next 6 months we see the consumption cycle is going to be positive. No doubt, only concern is the monsoon. As we know, the El Nino impact is been there in India, and definitely this time, because of cyclone that has been hit now, can be slightly crucial for food grain production and things. But El Nino will be definitely impacting a little bit. But overall, pre-election year is there, and maybe because of that, the announcement from the government side or support from the government side is going to be very tremendous. In infrastructure spending by government is continues to support the growth for India. Domestic demand recovery is being robust right now. Raw material cost is a challenge, no doubt, but India is a very good, we can say, other metals are available, which have been taking care, reduce import and promote domestic has been the policy right now. Adoption of new technology in India has been very good. Because of that, leakages has been dropped. Global steel prices has been a little bit concerned because China's slow started. We have seen first quarter was been slightly under pressure, but now things have been improving from the China side. And as we know, China has been a leading consumer for all commodity, and as we expect Q3, Q4 is going to be positive for China side. As consumption improve, that will definitely impact positively for India also. Competition from import has been not a bigger thing, but I think positive growth outlook and government initiative is been very good for steel. So overall, we can sum up with things like Indian as of now, things have been slightly positive in last couple of years. Government is doing a very good initiative, starting with many funds that are supporting domestic side. And no doubt some concern related to recession and high cost of commodity has been there to the market. But in all, looking to the current spending from the government and private sectors are been very much supportive, and we expect consumption for steel is going to be positive. And right now, if we compare domestic market to NCDX steel, NCDX is an exchange in India, and the steel is being very well traded over here. Here we can see June contract is showing 49. July contract is showing a price around 46,700. We expect in next couple of months or 3 months, things have been improving, and we may see prices retesting around 49,000 to 50,000, which is around 5 to 6% gain in the prices can be seen, looking to the consumption and growth story going on in India. That's all from my side. GDP numbers are quite good. Expenditures are good. Government initiatives are good. And consumption for steel industry and ferro metal is going to be positive. I know some points are being still missing, but definitely in next session we will be coming directly on metals. So over to you. Thank you so much.
Okay, thank you so much, Mr. Ajay, for your very detailed presentation on India macro as well as on the ferrous industry. So yeah, without further ado, let me just quickly give a very quick introduction of Juno. So Juno, she's actually our one of our chief macro analysts. So Juno, she's actually very experienced in macro research, trend identification, and forecasting using both fundamental analysis and quantitative models. So prior to joining Horizon Insights, Juno actually worked for the World Bank and the IMF, International Monetary Fund, in the States for 4 years. So Juno obtained her bachelor's degree from Shanghai University of Finance and Economics, as well as gotten her master's degree from Cornell University, as well as Columbia Business School. So right now, Juno will be presenting on China macro, as well as the outlook for ferrous metals. So yeah, over to you, Juno. Thank you.
Thanks, Stephanie. Can you hear me? Oops.
Yes, we can. Very clear.
Awesome. Right. So thanks everyone for attending, and then let's dive right in, I think, because we have a lot to cover as we have a lot of slides right here, as you can tell. So for today's session, I'm going to talk about our overall look onto the Chinese economy, as well as our forecast on the ferrous metal as well. So first off, in order to understand the Chinese economy, I think it's important to understand usually we have a GDP growth target that's been given out typically during the 2 sessions in March every year. And for this year, the target is the 5% GDP growth. So what does that mean? That basically translates to a stable growth, meaning that for this year, we don't have a strong calling for a expansionary economy. So more specifically, if you look onto your right-hand side over here, we have a breakdown of GDP. So for this year, for 2023, we all know that because we've been in a continuous, on and off lockdown in the past 2 years, especially in the last year. So this year, there's going to be a natural rebound in consumption. So how much of that rebound can contribute to GDP growth? You can look to your left-hand side over here. We displayed how, China's service PMI can be a leading indicator in observing, the service GDP contribution. So you can tell from just that this year, we estimated that the service GDP contribution is going to be about over 3%. It's going to contribute to basically 3% of GDP growth, meaning that the rest of the economy, especially the 3 major pillars, namely manufacturing, infrastructure, and property investment, only have to contribute to 2%, or maybe a little bit more because we have export declining this year. So we have those 3, we don't have that much pressure onto these 3 sectors in order to realize a 5% GDP. However, that said, we have to take into consideration 2 factors. First, I've mentioned briefly, that is, we have a net export declining this year. People don't know how much decline that's going to be because that depends on whether the US or the European economy overall are going to see a recession, or are they going to be a more like a soft landing. In that case, maybe export won't see that much of a decline, but that depends on the global economy overall. So that's one thing. The other thing is that right now the property market is not looking very well in China. Although for this year we've lifted some restrictions already, we've seen some policy taken into effect, but still people are arguing whether these are the effective kind of policies that the market are awaiting. So still we need to address the problem of whether the property market are going to contribute some growth to the economy growth this year. So overall, as you can tell, we think that it's not hard to achieve the 5% GDP growth target, mainly because consumption is going to be on a trended upward trend. But still, we have to take into consideration the potential decline in the 2 sectors over here. So now let's take a more specific look onto each pillar. One sec, this won't. Trying to hide this. Yeah. All right. Yeah. So first, let's look at infrastructure. Is infrastructure investment in line with market expectation? The quick answer is yes. So first off, why do people care about infrastructure investment? Typically in China, that is viewed as kind of a support to the market, especially during a downward cycle. Now, one thing that the market worried about was indicated here by a decline in the growth rate of investment growth into the transportation, storage, and post sector. This is one of the major sectors that constitute the infrastructure investment. There are three altogether. This one is particularly important because it contributes more to consumption of construction goods. So whenever people realize that there's actually a decline onto the growth rate, people are worried whether this year infrastructure is going to be a continuous support to the overall consumption of the construction material. So that's when we started to see the market trading downwards, basically are worried about whether infrastructure investment is going to be resilient, is going to be strong throughout the year. And we think so far the investment growth in the infrastructure sector is in line with expectation, meaning that it's going to be similar to last year's trend. In the first half of the year and going into the third quarter, it's going to be the growth rate of here I'm showing the special purpose loan, the growth rate of special purpose loan. So right now up until May, we've seen nearly 60% of the special purpose loan quota has been used up. So the rest of the 40% are going to be used in June and the third quarter. So far it is in line with expectation. What's causing some fluctuations is because we've mentioned that there are three major sectors that infrastructure investment are put into. So the most important of that is the transportation sector. So the fluctuations are introduced by whether the fund is going into the sector or it's going into other sectors for the time being. So you've seen that fluctuation, but the overall investment itself has been high. And then what about manufacturing investment? For that, we can look at the manufacturing PMI. For this year, we didn't see a continuous expansion in manufacturing PMI. Instead, we've seen very huge fluctuations, meaning that still the market isn't confident in the end demand, in the terminal demand, and they are worried about whether such terminal demand is going to serve as a support to the production. So if you look to your right-hand side here, we're displaying the inventory cycle of the Chinese economy. You can see that both the finished goods, which is the blue line, and the black line, which is the raw material inventory, both are declining, meaning that whatever reason, it could be that terminal demand isn't good enough so that the enterprises are not producing as much, or that liquidity condition isn't easing as fast as they are expecting, so that they are not restocking either. It could be both, or it could be either. But the effect is that the industrial enterprises are not restocking or producing. They are actually actively destocking on their inventory. So in order for that to reverse, one of the way could be that we see M1 increase, meaning that right now there's a lot of savings sitting in the household sector's balance sheet. If they are willing to spend that either through consumption or through investment into the real estate sector, that could potentially serve as a drive on production, or that this is on the liquidity side, or that this is on demand side, or that if we see M2 increase, that could be translated into an increase in total social financing. If the overall liquidity condition increases and the enterprises has more money on hand, then they might be willing to restock as well. But right now we're not seeing either. So what happened in the futures market is that people realize such is the condition that no one is willing to really purchase or restock. In that case, the market continued to squeeze out the production margin of the manufacturing enterprises. On your left-hand side, the blue line is the industrial enterprises production margin. So that is still very low. And if you look at some leading indicators, such as the land transaction, this is a leading indicator of typically new starts and things like construction are both reflected in such an indicator. So that could potentially mean that we've possibly already hit the bottom of enterprises' production margin. But in the futures market, in the past 2 to 3 months, what we've seen is that the price of rebar, as well as some other manufacturing products, here we've used Nanhua Industrial Product Index as an overall look of the prices of the industrial products, and it's been declining. During the decline, the production cost is also being squeezed down as well. So overall, people are not giving much margin to the industrial enterprises. But right now, that trend seems to be reversed. So we're going to talk about that later. Now, this is manufacturing. So we've seen that infrastructure investment is okay. It's just it fluctuates because of how much funds are being, spent into different sectors. And on manufacturing, the enterprises are not restocking yet. What about property investment? Here is where the most problem is lied. So you've seen that for this year, most growth is seen on the completed floor area. That is the black line. But on new investment, on new starts, they are actually continue to decline. And one of the leading indicator we can take a look at is the floor space sold. Here we're looking at the daily sales number across the 3 major cities in China. So it's already hit the bottom if you compare to seasonal patterns. So right now, people are worried about whether this is going to be the case throughout the year. Basically, your demand is actually declining if you compare to last year, the year-on-year growth. Will it see a growth or will it see a decrease this year? So right now, people have high expectations on policy stimuluses, and we've already seen some of the policies being rolled out, and we think that is going to continue for a bit. So, for instance, some type of policies that are considered useful. One of them are the restrictions on basically the lift of restrictions on the purchase of housings. So right now, China has purchase restrictions on your second housing in a lot of cities. So here we've listed some major cities and their contribution to the national growth of the overall basically growth in sales. So right now we've already seen such restriction being lifted in Qingdao City. And you've seen that is the execution date is on June 1st, and we've already seen the sales number picking up. So meaning that that policy is effective. If we were to apply that policy to some other cities, it could send out a positive signal and could help with the sales number. So now people wait for similar stimuluses to come out. Will it come out, and how much of the magnitude will it be is something we have to wait and see. But we think for now, we will continue to see some policy stimuluses coming out. And for this year, as we mentioned in the beginning, the GDP growth target is very low, it's 5%, meaning that instead of craving for a high growth this year, the government actually has some other issues on their mind. And one of them is really to solve some structural problems in China, in Chinese economy. And one of them is that we have very high inventory in housing. So here we're displaying the housing inventory and how much time that potentially translates into sales turnover. You can see both are high. On the other hand, during the past few years, it has been observed that a lot of the developers are focused on new starts, basically meaning high turnover, meaning that whenever they purchase land, they're going to start very soon, but they're not really delivering. Instead, they're taking that money to acquire more lands and start more projects. During such time, their leverage ratio basically increased very high. So for this year, the government has to solve, first off, the inventory is really high. We have to consume those inventory before we expand again. And the second is that we have to deliver the construction works that has been delayed in the past. So this year we're going to continue to see construction outperform new starts. Then I mentioned that we think some policies are going to come out. And last week we've already seen a decline in in OMO rate as well as MLF, which is the policy rate in China. And tomorrow we're going to see the LPR rates coming out, and we think we're going to see another cut as well. It's the magnitude that we care about. And what else? Even though we have this type of monetary policy support, still we don't think that's going to be the right policy to solve the problems. In this figure, you can see that right now the mortgage rate in China is really low. We had it reversed, so right now it's declining, the red line. Still, that is not reflected in the property sales number, which is the blue line. So we think just lowering the mortgage rate isn't the right way to target it. The most important issue we have to figure out is that the leverage ratio for the household sector as well as for the developer sectors are pretty high. So in order for them to really expand again, to invest again, we have to solve the problem of their balance sheet. And do we see those policies coming out? Not yet. Are we going to see those possible only if the current policies are proved ineffective? So we're going to have to wait and see. So overall, the problem with the Chinese economy is simple and complex at the same time. It is simple because you can take a look at this left-hand side figure. Right now, we've already seen that the M2 growth rate picking up, meaning that the government is willing to give more quota to the banks, for the banks to give out more credit to the real economy. However, the real economy are not taking those credits. So if you take the difference between China's total social financing growth rate, and you take the difference between that and M2 growth rate, you can see that it's actually declining, meaning that M2 is increasing at a much more higher speed than how much people are actually borrowing, people are actually spending. And if you look at the US economy, that is totally a reversal of the Chinese economy. Even though US has been raising its rates, and you've seen that M2 growth rate has already contracted, it's already declining, still people are spending, so that the difference between total social financing and M2 growth rate is actually still positive. Its monetary policy is tightened, but still not translated into a tightened credit cycle. So this is why we're seeing that right now China, the monetary policy itself may not be the right solution to the problem. Now, I think that should be enough for this, but still lowering the interest rate can be helpful to the commodity prices and to risky asset prices as well. It's just that you will have to wait and see the fundamentals improve to see that a price elasticity come back again. So right now we're thinking that the positive policy stimulus expectations is going to bring some upside to the commodity prices, but still people await for the terminal demand to really come back to respond to the policies in order to give more premium to the prices. One proof of that is if you look at this is here, I'm displaying the Golden Dragon China Index, which is listed on NASDAQ US. So typically that tracks the overall liquidity cycle in China. So here I'm displaying the red line is the total social financing growth rate or momentum, because we've done a 12-month moving average. So that's basically reflecting how much liquidity there is in the Chinese economy, meaning that whenever we are able to see people becoming more willing to spend, total social financing growth rate start to pick up, we're going to see more upside onto the risky assets in China. All right, I think that's enough for macro, and now let's talk about ferrous metal. So we've mentioned in the this year, since the beginning of the year, because China reopened our economy, so people give some upside to the commodity prices. But then we've entered a 2 to 3 months decline of commodity prices. And during that decline, you can see that production cost has been declining as well. So this is a reflection of the market is basically squeezing out all the profit in the production, in the manufacturing enterprises. So right now, futures market are rebounding, and such rebound is not because demand coming back up. Rather, it's because of the cutting production. So what we've observed in the past few months is that both the blast furnaces as well as the electric furnaces production has been declining. And during such decline, we've seen electric furnaces decline by more. So such decline has already resulted in a very fast decline in inventory overall. So we think as long as the rebar apparent consumption remains fluctuation, it remains, the same kind of the similar level as last year. As long as there's no huge drop, we don't even need to see a jump in consumption. Then given the current level of production, we think that very soon people will realize that inventory decline is going to be much faster than seasonal pattern. And people may start to treat on the fact that current cut in production is enough and may result in a soon, increase in production because of rebalancing. Now, here we give you two scenarios. First of that is a more plausible and a positive scenario, which is if we assume that for this entire year, the demand is going to perform about the same as last year. So we apply the same year-on-year growth rate as of 2022. Then given the current level of production, we're going to soon see that, the rebar inventory decline to zero in the third quarter. Then meaning that there's going to be more upside for rebar prices. And a second, which is a more negative scenario, but we don't think it's as much possible, is that if we assume demand is going to be similar to 2021. During 2021, especially the second half, there was policies such as 3 red lines being rolled out, and that's limiting the developers, capability to take on more leverages to get credit, basically. In that case, we're going to see a continued decline in demand in the real estate sector. In that case, then the current level of production isn't enough. Then we're going to soon see an increase in inventory, and that's going to press down the valuation of rebar. But we think this scenario is less possible, especially given the fact that there are policies coming out right now. And the other thing we think possible is that we could observe the scrap production. So right now, scrap steel in China is the supply of it and the pricing of it are both declining because of rebar future prices declining, especially production of electric furnaces declining. So the need for scrap is declining. So, but in the past, given the current level of price difference, we think very soon we're going to see that scrap becoming cheaper for the steel mills. If they were to increase their production, they might turn to the scrap for incremental production because of a cheap valuation. So that's one thing we could observe. If that ever happened, meaning that the upper bound for rebar is going to be, we're going to have to adjust up that upper limit. And we think right now that upper bound right here is tracking the rebar production cost of the blast furnaces. So if we were to see the production coming back up because of terminal demand coming back up and people realize that current speed of destocking is too high, if that ever happens, then we think the upper bound of rebar is going to catch up to the electric furnace production cost. And right now it's about 3,800 Chinese yuan. So this is our short-term view on rebar. And here I've shown you some price scenarios we've given on rebar. So a bullish scenario, which is right now, basically people have expectations for policy stimuluses. And right now our price target is 3,750. This is already, so rebar is already this price right now. And for it to go higher than that, we think we have to see, first off, the peak season have to see resilient demand. And then some of the production control plan have to be executed. Right now, people have the expectation that potentially for the entire year, the production of steel has to be the same as last year, but this hasn't been confirmed yet. But if so, then for the rest of the year, we think the upper bound for rebar could potentially reach 4,000. But a more bearish, scenario, which has to be, we have to wait on the, data, is that first off, we don't see as much effective policies. If in that case, we think rebar can drop to the previous low, which is 3,400. And going forward in the second half of the year, if the peak season demand is lower than the market expectation, then we're going to come back to the old trading logic, which is the market will continue to squeeze out the steel mills production profit in order to see a cut in production. In that case, we could potentially see the rebar price drop to even 3,200. And on iron ore, currently, given the current level of the current level of steel mills profit, we think the current hot metal output is already very high. For it to continue to increase, we will have to see an improvement in the steel mills production profit. So we think there's very limited upside for iron ore. Still right now, as long as rebar price is increasing, that would drive up the price of iron ore as well. It's just the upside could be very limited. So right now we're given it $120 upper bound, which translates to 830 to 850 Chinese yuan. For the lower bound, we think maybe previous low could be a kind of a solid support, which is 105 to 110 US dollar. And then on coking coal, right now it seems that it has stopped its price decline, but we think that's transitory. So the lower bound for coking coal we're given is near its cost support. So here we have to consider that a lot of the coking coal companies in China have entered into long-term agreements. So for that long-term agreements, the average price is about 670. So we think somewhere between that and 770 could be a very firm price support for coking coal. And the reason we think that price could continue to decline in the second half of the year for coking coal is because of the oversupply situation continue. So right now from Mongolia, the import is still high, and we think it's going to remain relatively high. Let alone that we're not taking into consideration potential import from Australia. Right now, the price in Australia is not attractive, so that import hasn't started. Once that import come into the market, that will continue to drive down the valuation of coking coal again. And right now, coking coal, the price decline kind of stopped. We think that is only transitory because right now we've seen some inventory started to decline. But given the oversupplied situation in the second half of the year, especially continue increase in import from Australia and from Mongolia. So we think we have not seen the bottom of coking coal. I think that concludes my presentation. But overall, I wanted to also mention that for this year, people also pay a lot attention to export in China. So right now, exports such as vehicles, such as some durables, such as the white goods, are still high. However, we've noticed that even though the total volume, the growth rate in total is high, but we've seen that the volume plays a much bigger factor, whereas price is actually declining. So going forward, we think the global demand is going to continue to decline, meaning that for the manufacturers, they would have to cut their price in order to sell much. So we think that is, I think that's all. And if you have questions, happy to discuss.
Okay, thank you so much, Juno, as well as Mr. Ajay early on for, giving a very in-depth presentation on, both India as well as China macro, as well as its impact on the ferrous industry. So currently it's Q&A session. So let me just, I did see some questions from the floor. So maybe, I'll take turns to, ask both Mr. Ajay as well as Juno. So perhaps maybe, to address the first question, this question will be directed towards Juno. So Juno, on your land sales number, it actually shows an increase year on year. So could this be, because it's inclusive of the left pocket as well as the right pocket, as well as government sales, local government sales to LGFDs?
Yeah, good question. But the numbers we're tracking on sales number under different measurements. So we track the ones that's been reported by the Bureau of Statistics of the Chinese government. And we're also tracking the one I've shown you is 30 cities. And we've also tracked 70 cities as well. So a lot of them are actually commercial housing sold to the household sector. So these are reflecting the actual demand in the household sector. So, but your concern, I think it's something, and we will consider that as a type of support to the real estate sector. And that is what happened last year. And I think it happened a little bit in this year, the first quarter of this year to Guangzhou City as well. So to support the overall sales, because that sales contribute to the local government's revenue as well, because they have to tax them. So the government decided to buy a certain amount of the commercial housing coming out that year, but that's only for a very limited number of cities. So, but that is not reflected in the overall sales numbers.
Okay, thank you, Juno, for answering. Next question, this will be addressed to Mr. Ajay. So Mr. Ajay, earlier on, you mentioned that steel consumption in India is set to increase significantly by 2030 with all the projects, as well as, the fact that India has actually implemented the national steel policy target of 300 million tons by 2030. So in your opinion, do you think that this will be sufficient to actually meet demand?
Yes, we have seen already India remain a bright spot in global steel industry in 2022, and already we have seen how India has managed the inflation and economy on a healthy growth track. So overall, we expect things have been in line only what government is expecting around 2030. Definitely our consumptions would be high. But still, it's a question because how the thing would be improving, because we have seen the production capacity post-COVID has been slightly concerning. But I think things would be improving, one side production, one side as economy is growing. Then definitely there will be a slight demand and supply mismatch, and that is why we are hopeful that prices could get some support from this deficit. So overall, in next 6 months is going to be a very crucial for global market, especially for India, because one side we are talking about the growth and other side the commodity cost, because in last previous 6 to 8 months the cost of commodity has been rapidly increased, but now things are being cooling off. So let's hope for same, but I think the demand is going to be further more as compared to the supply. That is why prices are going to be on a higher side.
Okay, thank you so much, Mr. Ajay, for clarifying as well as to explain. The third question would be, I guess this will be open to both Mr. Ajay as well as Juno. We have a question with regards to the coke price. So we heard that coke price actually inched up marginally, but do you think that from both of your views, do you think that this is actually a sustainable movement, or is it just a temporary thing?
Yeah, I can attempt that question first. So yeah, we think this is unsustainable. The reason for current coke price to kind of stop such decline is because of a couple of reasons. First off is, yes, we've seen a decline in inventory. So typically when that happens, the bulls may enter the market And second is that there had been some accidents in the mining sites in China. So that could be one of the reasons people may trade on, but we don't think the magnitude, the effect of such accidents, we don't know yet, and we have to wait and evaluate. But we don't think that's going to affect the market overall. So the reason we think coking coal price is going to continue to decline is that the market is very oversupplied this year. And if you consider that, then in the second half of the year, it's going to be oversupplied. On the other hand, coking coal is very relevant for the economic growth, and it's used both in the, manufacturing sector as well as in the household sector. So for goods like this, if it increased by too much, that would catch the regulatory, basically NDRC's attention, basically. So right now you have to consider the long-term agreement prices for coking coal. And as I mentioned, the upper bound, I think, I have to check. The upper bound is about 770 Chinese yuan. So potentially that could serve as a very firm price support. Meaning that if you were to decline, if you were oversupplied, if you were to decline, then you could potentially decline to that much. So overall, we think it's better to not, consider the current price as a trend. Instead, it's a fluctuation.
Okay, thank you very much, for clarifying. The next question will be for Mr. Ajay. So, Mr. Ajay, we have a question with regards to India's strong manufacturing PMI. So, just to check in terms of the, the strong manufacturing PMI, is it driven by the domestic market solely? Or in your opinion, which sector would you say is, the strongest? Because we see that, India's PMI is rising and is diverging from, other economies. So perhaps, Mr. Ajay, could you shed some light on this topic?
Yeah, as I have mentioned in my presentation, also post-COVID was very crucial for India, and definitely India has worked dynamically on various sectors. No doubt, infrastructure was the first sector we have seen. So we can say the demand or manufacturing PMI has been firstly driven by domestic side, and no doubt FDI investment was been slightly concerned last year, but now things have been cooling down. But as of now, domestic manufacturing activity like infrastructure, we have seen many road, railway infrastructure project has been taken care. Like we have a record Delhi-Mumbai corridor, or we can say major ports have been in revamping. So I think as of now, the driving factor was the Indian manufacturing activity, or particularly from the infrastructure. But hence, election period, we are in a pre-election period, and in 2024 up till March, April, we will be having a general election in India. And definitely because of that, in next 6 months, the industrial investment activity or construction activity is going to be there. In regards with the housing sector also, we are placed in Mumbai, which is we can say financial capital of India. Here also we have seen demand has been revamping despite interest rate hike has been seen in last 6-8 months. But demand from housing sector and manufacturing or infrastructure is still robust here. Manufacturing PMI in India is mainly driven by the domestic factor right now.
Okay, thank you very much, Mr. Ajay, for the clarification as well as for sharing. Okay, next up, this question will be, I guess, catered towards both parties. So in terms of, I think a question that was actually asked was the fact that, what are the main challenges that you think that the steel industry is facing now? More specifically, the SAIL, which is the Steel Authority of India Limited, SAIL, which is one of the largest steelmaking companies in India. But they were still not able to reach even 87 from the last 52 weeks. So what's the reason for that? Is it because due to previous years of Chinese lockdown, or is there a downfall in liquidity, transportation? What exactly is the major factor? Yeah, if either Juno or Mr. Ajay could actually help to clarify.
Yeah, I am taking. See, on the part of the sale, or we can say Indian steel company, no doubt things have been improved in last 1 year period. But still, there are certain challenges we have seen, like raw material availability, because in 2022, second half was very much challenging, where we have seen all raw material prices has rapidly gained, high production cost, competition from other, we can say import was not very much challenging right now, because in last 4 or 5 years, India has cut down their import significantly. But we can say environmental concerns, regulation, government is very much keen about the development, but we have seen compliance has been very much high because of that ability of skill, manpower, or insufficient supply chain management, volatility in global prices. These were the factors. Because of that, things have been still on a, we can say, fragile area in Indian steel market, but hopefully things have been will sort down in next coming 3 to 6 month period. But up till now, whatever the level we were expecting here, India should go ahead, has been slightly suppressed because of this concern, like a high production or skilled manpower or local, we can say, factor, not a international factor.
Okay, thank you for the clarification, Mr. Ajay. The next question will be open to both of you guys. So, in terms of your opinion, what do you foresee the outlook of, iron ore and pellets to be? Yeah, this question is open to both Mr. Ajay as well as Juno.
Right, let me quickly classify as I think this is Mr. Gosh, right? Is asking some questions, some follow-ups. So first, I don't have the pricing at hand of coke price, but coke is tracking coking coal right now. So if we think that coking coal price increase isn't sustainable, then that means that the current upward trend for coke price isn't sustainable either. But I can, because we have a coke and coking coal analyst right here with us. I'm not right here, but with us. So he's already off work. So I can revert back to you on this specific question on our views on coke price tomorrow. And on steel margins, I think right now in China, the steel margin is about 100 yuan. And that is not high, but still positive, because last year they continued to see, basically negative margins. Basically, they're not producing at profit. So at current level of the steel margin, we think it's hard for it to expand unless we see continuous, very effective, basically, policy coming out. The effective ones, like I mentioned, are the ones targeting the property market specifically, and ones like lifting the restrictions on purchases, things like this. That's very strictly targeting the problem, but we haven't saw those yet. And the second could be that we have to see the terminal demand coming back up, especially during the peak season, which should start from September. So we have to wait and see that. To see people give more, premium to the steel margins. And on iron ore, I think I've made my points clear. So maybe if KEDIA wants to make some comments, but in our view, we think currently iron ore is tracking rebar. So as long as rebar is increasing, as long as the terminal demand is not proven to be weak during the peak season, then the current upward trend may continue. It's just that we think the upside for iron ore price could be very limited as compared to rebar. And in the second half of the year, we think the lower bound for iron ore could drop potentially to 105 to 110 US$ if the terminal demand in China proved to be just weak. So yeah, that's our overall view.
Yeah. Coming on the iron ore, we expect prices have been showing us tremendous recovery since May month has started. We have seen prices move from 102 to almost trading near to 114. Upside is definitely will be limited. We may see prices moving towards 123, 24, not beyond the level what we have seen in the month of March, that is 131 level. So I think upside would be there in second half as updated, things would be improving demand side, and there are various other factors because we have seen in first half crude prices has moved very rapidly in a broader range. Yesterday also there was a statement from Russian energy minister that prices should go up to $80 mark for Brent as an average. So have to see other factor also, but I'm not so much bearish. We may see first upside towards 124, 125 zone, then maybe prices could consolidate, but totally depend upon the how economy perform, because still the recession fear in Western world and domestic also we are not getting very much clear we can say clues from India, or because in India we will be having an election period, and from China also things have been slightly keep on changing. So I think initially a bounce towards 124, 125 could be possible on domestic side. NCDX still we can see right now it's trading around 46, 550 level, looking to the domestic demand slowly and steadily. Whenever there is a falling price, immediately demand increases. So we may see what we have seen in the month of March, that is 50,000 level in case of domestic. In Indian terms, right now it's around 46,500. A jump towards 50,000 could be possible. Not beyond that level, consolidation is expected as we move year end. But definitely for next couple of months, they're going to be a positive for iron ore and Indian steel.
Okay, thank you very much, Juno and Mr. Ajay for sharing. I think, we'll take one last question. And this question will be towards Juno. So Juno, how constraining is the current local government debt, whereby, what to see, further effective stimulus to be rolled out? Like, what's your view on this?
I think this is a very sharp question. We think that is one of the major constraints on the Chinese economy right now. And to solve that question could be hard and easy at the same time. Because typically, like right now, we think the government wants to solve it kind of the hard way, which is they want, because we have to solve a lot of structural problems, right? So for this year, they wanted for the real estate sector developers to really depend on the sales number instead of credits from just cheap credits from banks. So they want them to get their credits from the sales and then to develop as depending on how much really sales they're making. But in that case, meaning that basically the recovery of income for the local government could be very slow because you have to depend on the sales as well. So if they were to stimulate the economy this year, then they have to do something maybe special instead of relying on the market power. So we don't know if they're going to do that. But if they were to do that, that could be something like if they could set up like an SPV, like a special purpose vehicle, and that special purpose vehicle could take over the bad debts from the banks, from the local government's balance sheets, and then inject instead, equity into the local government. In that case, that would be a very easy solution to the problem. So right now, we don't see that yet. So yeah, that's just, we're gonna have to wait and see again. Yeah.
Okay, all right. Thank you, Juno, for taking the last question as well as for helping to close the event. So once again, thank you everyone, especially our speakers, Mr. Ajay, as well as Juno, for taking the time to actually go through, your insights as well as to deliver a very comprehensive presentation. I'm sure that everyone here actually learned something new. So yeah, if let's just say, unfortunately we can't take all questions, but if let's just say you guys have any questions to follow up, to ask our speakers, please feel free to send an email across. My email is actually located right at the registration link. So if you have any questions, please feel free to reply my email and then I'll refer your questions to the relevant speakers respectively. All right. So yeah, thank you so much, everyone. Have a great day ahead. And we'll catch you guys soon. All right. Thank you.
Thank you.
Thank you.
Bye.
Thank you.
Thank you.